G'day, fools. Scott Phillips here from the Motley Fool, and welcome to day 5 of Financial Literacy Week. Thank you to each and every one of you who's been here all week. You may hit some of them if this is your first one. Thank you for joining here as well. Already got some questions coming in, which is fantastic. Cool. I've got some great questions. That's unreal. Thank you very much. I want to quickly recap what we've talked about this week as we go into your questions about all things money, finance, investing. Let's do the whole lot. We've got an hour. We're only going to do half an hour. We've got so many great questions. We're going to make it an hour long. If you want to hang around that long, if there are no more questions, I guess I'll sing for the last 15 minutes. So you've been warned. If there are no questions, you're going to hear me sing. No one wants that. Ask my wife. Now, let's start with where we finished off yesterday. In fact, let's not do that. Let's go all the way back to Monday. What we've spent this week trying to do is to tell you how, frankly, simple, not necessarily easy, it is to take control of your financial life. We talked a lot about knowing where you're at. We talked a lot about the fundamentals, what you need to do to put yourself in a position where you can work towards financial freedom, whatever that is for you, whatever you're saving for, whatever you're aiming for. We want to help you do that, and I hope we've done that over the past 4 days, sorry, not 4 weeks. Feels like that long, so maybe for you guys, sorry. Only 4 days for me. We talked about budgeting. We talked about living below your means. We talked about the need to go and hopefully earn a bit extra, hopefully spend a little bit less. We talked about the need to put aside an emergency rainy day fund so you don't have to dig into your investing or, frankly, find yourself unable to pay those bills as and when they come due. We talked about dumping your debts. We talked about getting in front financially, making sure you're in a position where you can strive for financial freedom, put some of those building blocks in place, take away some of those obstacles to get you back in front. We talked about investing. It is my passion, I suppose. But frankly, here's the thing, right? I don't get out of bed hoping to make rich people a little bit richer. That's what a lot of my industry does. And I have no problem with that, by the way. If you're already rich, great, congratulations. If you can earn some more on your money, then you're very, very welcome to. And if I can help you do that, I'm very happy to do that. What I want to do, frankly, fundamentally, is help the average Australian, just people like you, me, my friends and family, get a bit ahead financially. Get the knowledge, apply that knowledge to earn, save, invest, and get ahead. That's exactly what I'm passionate about. That's why I joined the Motley Fool some 13 years ago now, and why I'm still here, because we have a lot left to do to help Australians get to that place. And congratulations if you're here, because it means you or someone you love has decided you should be here to try and get yourself on the right path financially. That's what we've done this week. If you want more resources from the Motley Fool, we've got on our website, it's a free website. Go to fool.com.au/education. Pretty straightforward. Don't do it now. Do it after this video. I want you to hang around. Fool.com.au/education. That's got a whole heap of great content. Investing terms, personal finance terms, tips, strategies, techniques to get ahead financially. By the way, I've also got horrible hay fever or a cold this morning. So, this afternoon now. I am battling. So if I have to mute and blow my nose, I'll apologize in advance. I'll try and minimize that. But it's going to be an hour long, and I'm already struggling. Got a drink here beside me too, so I may get into that. We'll see how we go. Let's get into the questions you've got for me. This is interactive. Got some great questions already on the YouTube live chat, which is unreal. Thank you. Another one's just dropped in. Got it all. Thank you very much. So let's get through those. I will start with the questions we had during the week, because we asked some questions during the week. You've been very, very patient in letting me effectively put those to the side. Look, I'll come back on Friday, because the questions were about some of the stuff we were going to cover in future periods. And it just wasn't the right time for the flow of the webinars, the flow of the Financial Literacy Week program, to kind of try and go off tangent and bring it back. So thank you for giving me some time and some space to do that. Great questions from Craig, the Rural Juror, Jeff, Pamper, Christine, Hester. We'll get to those as well. I'll start with some earlier this week. And in fact, this covers the same question as the Rural Jurors asked. Is it worth only paying the minimum repayment for HECS and using the money you'd use to pay it off faster to buy stocks, or should you try and pay it off faster to avoid indexation? Similar question. What is your view on paying down HECS earlier or keep it for 30 years or longer? What do you think about the priority of paying off more of your HECS? So lots of questions on the same theme. I will say, by the way, up front, I can't give any of you personal finance advice. I'm a general financial advisor. That means I can tell you what I think about an issue. I can't tell you what you personally should do, how it applies to your personal circumstances. That applies to the questions on HECS and every other question that I'm going to talk about today. That is up to you to work out for yourself. I'm just not allowed to. ASIC wouldn't let me for reasonable reasons, right? I don't know the rest of your circumstances. So I can't say on the back of a single question, here's what you should personally do. On the HECS thing, let me do both sides of it and I'll give you my view. First thing, if you pay it off now, you may get an early payment bonus and you also avoid that indexation we've talked about. Now, at the moment, that indexation is really high. Why? Because inflation is really high. It's coming down, by the way, 3.4% just this week. 4.1% was the last quarterly number. So we're going in the right direction. That's a real positive. So don't fixate on past indexation or even the current one. When you get the bill, you'll be like, oh my God, this is terrible. You can't avoid that now. Future indexation, hopefully, if the RBA and the government are doing their jobs, and cross our fingers, hopefully will be less. So just keep that in mind. Broadly speaking, purely mathematically, you want to take the highest return potential idea. If I can get 10% over here or 2% over there, what should I do? I should take the 10% option. If your HECS is going to index at 3 or 4% and you can get 7 or 8% investing, then you should, in theory, and don't switch off just yet, in theory, take the higher return option. Get ahead by investing more where you're going to get a better return for it. Your $100 over here goes to 107. Your $100 of debt over here goes to 103, 104. The maths hopefully is pretty clear. It makes a bit of sense as to what you should do. Excuse me. Oh, man. All right. Try and keep that to a minimum. So that's the theory behind it, right? That's what you should, in theory, do. Couple of things. Firstly, you have to actually make sure you do invest that difference. I'll get to housing in a minute on the same question. It theoretically is fine, but only if you follow through with the behaviors over the rest of the term of that HECS debt, for example. If you don't do that and you spend the money somewhere else, then you've got a HECS debt and you haven't saved. So you've got to see it all the way through, not just for a couple of months or a year and a half. You've got to see it right through to the end. Otherwise, the indexing that compounds on your HECS will get away from you if you don't keep putting the same money aside, at least for your investing. So keep that in mind. That's really, really important. Two other concerns. Secondly, your return in the share market or any other investment is volatile and uncertain. HECS indexation, while it's variable in terms of inflation, it's pretty much guaranteed at that inflation rate, right? So it's a certainty. Over here, it's a possibility. So there should be some difference there. The last thing is you're going to pay tax on your investment gains. You're going to save money, or you're not going to pay tax, but effectively it's tax-free, the gain you get by paying off HECS more quickly. So again, think about the return. A 7% return over here, maybe only 5% after tax, because you get the 7%, you pay a couple percent in tax, you get back to 5. If you're going to make 3 or 4 over here with HECS, it's kind of line ball. Last consideration is the peace of mind test. Wouldn't it be good just to get rid of HECS and get it over and done with? Some people are like, yeah, absolutely. I can't wait till that's off my mind. Others like, no, I don't care. Money's money. I don't really care what did I owe. I'm happy to do that. So use those considerations as you think it through. Mathematically, you should go with the highest return potential, as long as that return potential is reasonably certain, or at least approximately certain. I know that's not really a thing, but you know what I mean. There's no certainties, but if it's likely, that's a good thing. Also consider the taxation implications of that higher return you're going to get somewhere else. By the way, you could lose money if you buy the wrong shares, right? So again, you might go backwards, whereas HECS might still index at 3 or 4% where you're going backwards with your shares. That's even more painful. The last one on the behavioral thing is, again, I talked about seeing it through. If you say, I'll invest in shares, that's a better idea. Shares drop 10%, your 100 goes to 90, and you think, oh man, I was stupid. Okay, I'm getting out now. You've locked in your 10% fall. If the market then recovers, but you've already sold, you've actually doubled. You cost yourself twice, right? Not only do you lose money, you miss the opportunity for a subsequent gain. Your HECS debt continues to index. I got to say, really honestly, whatever the inflation number is high-ish, and I'm talking 3-4%, I'd be inclined to go for HECS, just get it out of the way. Yogi Berra, the baseball's got a great quote. In theory, there's no difference between theory and practice, but in practice there is. The peace of mind, the certainty of paying off HECS, I'd be inclined to go down that path if it was me. Question from, what do we get here? Again, the rural juror might have asked questions on two separate names. I'm not entirely sure. Great question. Please keep them coming in. Craig says, just quickly, HECS will also affect your debt or credit rating. I don't know, mate. I don't know the answer to that. And the good thing about working at the Motley Fool is I get to say I don't know when I don't know. I don't want to mislead anybody. So I'm going to say I don't know just to avoid leading into up the garden path. Check that if you're not sure. I don't know the answer. It certainly affects how much you can borrow. But in theory, again, the amount of debt, the amount of investment should offset each other. They may not with the bank, and that might be something to consider as well. So it's a really good point, mate. Thank you for raising it. What is your opinion of renting long-term? Oh, my screen's over here, by the way. My camera's here, but the screen's over here. That's why I'm looking sideways. What's your opinion on renting long-term and investing in shares with your money instead of buying a house to live in? If you don't own your house, does that take priority before buying shares? Very good question. What's your opinion of renting long-term, investing in shares, your money instead of buying? Raymond says, I asked this question in the last session. Should I sell my home and invest the entire profit, $1 million, he says, in a diversified share, ETF, or stock portfolio and rent? Exactly the same thing. Exactly the same thing as HECS. The same considerations. If you weren't listening with that, I'll quickly recap, but I won't overdo it. I expect shares will do better than property over the long term. Why? Because I think over time, excuse me. Oh, man. Bad video etiquette, isn't it? I think over time, we're going to see the share market accelerate faster than property. That hasn't been the case in the last 30 years. And so ordinarily, you'd say, well, hang on, past performance, future performance, what's going on, what should change? There's been 3 or 4 things that have driven property prices higher, changed the rate of growth, if you like. So the rate of growth was pretty flat for, frankly, centuries, but certainly decades. Then it kind of tilted up for 30 or 40 years. Why? We had lower interest rates overall. We had second incomes in households. We had banks lowering their loan to valuation ratios. In other words, you could buy a bigger house with a lower deposit and longer mortgage terms. So those things all happen at once, right? So acceleration, 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 acceleration. You see house prices. People can afford to pay more for houses. So we did. I'm going to sneeze, excuse me. Terrible, my apologies. Prices went up because they could. We all spent a whole lot more on houses. Probably not great socially, not what I would suggest we should do as a society, but it's what we did. So we were going at that rate. We're now going at that rate. I would suspect, unless you had a third income to a household, unless you have 100-year mortgages, unless loan to valuation ratios go negative, unless interest rates go negative, what's going to propel the next, not to say house prices can't go up, but the rate of growth, the rate of increase will simply be lower than it would have otherwise been. Shares, on the other hand, are a subset of businesses. There's probably 1,500, 1,800 companies on the ASX out of a couple of million businesses in the country. They, in theory, are the biggest and most of the best. Some are absolute rubbish on the share market, by the way. Some are wonderful, some in between. There's some wonderful private companies too, by the way. But the group on the ASX tend to grow. They tend to take market share. They tend to outperform and grow faster than the economy. If house prices are effectively constrained over the long term by wages growth, but the profit of this subset on the ASX is not, in other words, they can grow faster than the economy, faster than wages, because they're taking more and more money, more and more market share, a greater portion of the economy. They can outgrow, in my view, the property market. Now, I'm a shares guy. You say, well, you're a shares guy. You would say that? Maybe. I've had an investment property before. I would buy one again. I said this during the week. I am not someone who says, I'm only shares, I don't care. Why would I? I've got $100. I want to make some money with it. I put it in the best idea. I'm not going to say, well, property is better, but I don't want to buy shares because it's worse. That'd be a terrible thing to do. So I don't care. I recommend shares. I'll always recommend the best shares I can find. But with my own money, if an investment property was a better idea, I'd go with it. So if shares are going to grow faster than property, I think they will. Should you invest in shares rather than property? Again, the same things I mentioned with HECS. Firstly, for your own property, remember, it's capital gains tax-free. You don't get a deduction on the interest, but it's capital gains tax-free. So if I make $100,000 on my home, or $100,000 in shares, one of them's tax-free, the other one has a tax bill. So keep that in mind. That reduces your gain. The certainty of owning your own home. If I own my home, it might go up and down in value, but I'm going to stay here, live here. I'm not going to sell it and in a fit of peak because the share price or the house price fell 10% and go and live on the streets. I'm going to say, well, that sucks, but I'll stay here. You sell your home, or you don't buy a home, you buy $1 million worth of shares go down 10%, you think, this is stupid, I'm out of here. And you give up, you sell it to a lower price. Meanwhile, the house has gone up by a bit. So now not only are you behind the money you put in shares, you're even further behind the higher house price. So you just be a little bit careful there with the owner-occupied housing. Again, mathematically, I would suspect that the person in shares over 40 years, if they do it properly, that's a massive if. I call if the biggest small word in the English language. If you do it properly, mathematically on paper, I suspect that $1 million in shares today, $1 million in property today, I suspect in 40 years' time, you'd be very, very, very glad you went on shares, even if you had to pay rent in the meantime. But, that's if you do it properly, if you diversify properly, if you stay there through all the ups and downs, if you don't, sell in a fit of peak, buy the wrong shares, all that kind of stuff. I could be wrong about property, by the way. That's the other thing. And here's the thing. If you don't own your own home and you are wrong or I'm wrong, by the time it goes up and your shares don't, you're chasing something that's getting further and further away from you. So be very, very careful. I do invest in shares instead of investment property. I think that's a very, very different bet because you're not out a shelter if things go against you. All right, I hope that helps. Okay. Greg says, people often miss this when they compare shares versus real estate. When it's time to sell a house, you have to sell all of it. And the capital gains tax can be horrendous. Can be if you invest in property, not individual. But you're right, you have to sell the whole thing. You can't sell bits or one particular part of it. You can't sell a front bedroom because it's overvalued and keep the bathroom because it's undervalued, as you could with shares. But again, some people do different things. So good point, Greg. You say by timing the sale, I will take a slight exception to that, mate. And with a smile, I don't think you can time the market reliably, not you personally, but anyone in general. So be a little bit careful. You certainly can choose the point of sale if you get a particularly attractive offer to sell. And again, you go to the house as a one-off sale. You then got to buy something else to live in, by the way, if it's an owner-occupied house, if it's your own home. The investment property, you don't have to, and that's what I mean about treating those two assets slightly differently. Okay, next question. Marianne, I'm 65 years old with 500 grand in a self-managed super fund. Well done. I've invested in property and term deposits. How do I invest in shares and minimize or reduce the risk of loss? Marianne, you can't minimize the risk of loss entirely. The really honest answer is some companies' shares will fall. Some will fall temporarily. Some will fall permanently. If you're an AMP share, a whole lot, they've fallen almost consistently for 20 years. So let me be very, 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 very clear. I love investing in shares. I think I'll do very well over time. I think you can too. But there are risks that are simply always going to be with us. You're relying on someone else paying for those shares. But you can do a few things. Firstly, be diversified. Invest in 15, 20, or 25 companies or some index-based ETFs. By the way, stick around till the end. I've got a very, very attractive deal for everybody watching. I said earlier in the week I wasn't going to sell anything. Turns out I am. But the good thing is I've twisted some arms, and the price that I'm going to offer you is hard to believe. Put it that way. All right, stay for that. So be diversified. Buy some ETFs if you want to. You're going to have to ride out the rises and falls. The share market fell 38%. 38%, more than a third in 1 month and 4 days in early 2020 when COVID fear was at its worst. That meant $100 million went to $620,000. If you don't reckon it hurts to earn $80,000, ask someone who did. Wasn't me, but ask someone who did. That is really, 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 really painful. If you stayed around, the market's back at an all-time high. So the second part is how can you manage it? You manage it by staying invested, staying long-term. Be diversified, stay long-term. When I say diversified, by quality businesses, that's how I would go about, it's how I do personally go about diversifying my exposure, the services I run for the Motley Fool. That's what we do as well. We have volatility. We have some times when the share market is down. It falls for days or weeks or months or even years at a time. It's going to happen. Go make your peace with it. If you can't make your peace with that, please don't buy shares because you'll freak out, you'll hate it, you'll sell at a loss, you'll have no sleep, it'll be awful. But if you know that over time what's happened is every time there's been a big fall, there's been a recovery over time to higher and higher levels, then you're in a really, really good place. Can I promise it? No. Do I think it's likely? I think it's very, very, very likely. But you've got to stay the course. So, Marianne, that's the answer. If you want to invest in shares, the other thing is do it slowly and steadily. Build up over time to give you experience with that rise and fall and see how that feels. Greg said the other day, the same Greg actually. Thanks for watching again, Greg. Here's the problem for 18 to 30-year-olds. They're trying to buy a home, get married, have kids, etc. Just when their income is at its lowest. It's also when they really want to enjoy life by traveling. So where do the savings come from? We talked about saving. I think I put every spare cent into paying off the home loan first. I have no problem with that, Greg. Absolutely no problem whatsoever. And if people are watching saying, when I pay off the home loan, then I will start saving, I think that's perfectly fine. We just talked a little bit, though, about the difference between the cost of borrowing and the potential return from investing. And I've done part of that, by the way. My wife and I chose to pay down part of our mortgage in a lump sum, even though I had a very, very high conviction I could beat the return on that by investing. Why didn't I? Back to the stuff I talked about before, the behavioral and psychological benefits of having more of the mortgage paid off. We just wanted to be more in front. That was just a family, personal, psychological decision where we went, you know what? We'll sleep better, feel better. My wife will feel more comfortable. That's an easy decision to make. So should you pay the home loan off first? Up to you. I think a combination of both is probably good for most people. If I'm right about the returns from shares, mathematically you get further ahead by investing. Some combination of paying off the home loan, having some money in an offset, having some money then being built in growth assets. For me, it's shares. It might be property or something else for someone else. I would go with a combination of those for that reason personally. Again, Greg, what you do, what others do in that age bracket, entirely up to them. Hassan asks, how are we going for time? Not bad, actually. Thanks for all the questions, guys. I will scroll back up, answer some of these as we go. So I've answered some already. I'm going to answer some more. A reminder, if you don't ask enough questions, I'm going to sing. So keep that in mind too. Hassan, what is the reasonable average return a retail investor managing his or her portfolio should expect long term? Okay, the long-term average return over the last 120 odd years, 118 years, something like that, is about 9% per annum. Now that's the average. Very rarely exactly 9, sometimes 12, sometimes 4, sometimes -5, sometimes +15. Over the long term, the history suggests 9% is about right. Can I promise that'll be the future? No. Am I allowed to? No. Would it be ethical to do so? No. I would expect there's no reason why the future needs to be different to the past. And I'm talking the long-term past. I'm not talking about the last 10 years, 15 years, 20 years, 40 years, although funnily enough, the return of the last 30 years is about the same on average as the return for the last 120 odd years. So maybe the more things change, the more they stay the same. No promises. I would suspect the total market return over the next 40 years is closer to the last 30 than is likely to be different from the last 30 at a guess. What about, Hassan, another question, a couple of questions. What about all the decisions around stock market crashes and bubbles? How do you deal with such arguments? I don't, Hassan. I don't play that game, which sounds flippant and almost a bit silly, but it's absolutely true. I will be buying shares the day before a recession. I will be buying shares the week before a market crash. I will be buying shares probably on the day the market hits a high before it crashes. I will be buying shares the day, hopefully, it starts recovering from the next crash. Dollar cost averaging is the term. I wrote about it. I've written about it for what we call our take stock emails, goes to a couple of 100,000 people. Jump on our website at fool.com.au, just search DCA. If you remember, go to the Motley Fool Member Center at fool.com.au/member-center. You'll see it there as well. Dollar cost averaging is the way I deal with it, mate. Trying to time the market is madness. It's impossible to do, in my view, effectively and reasonably. I just keep buying. I believe if I add money regularly over time in quality businesses, I stay diversified. That's all I need to do. The returns will come from there. Do you see yourself as a technical or fundamental investor? Hassan, I'm a fundamental investor only. I don't ever look at stock market charts if I can help it. I certainly never do before I make an investment purchase. Why? Because I don't see evidence that it actually is helpful. Humans are wonderful pattern-seeking machines. We'll find a pattern, whether it exists or not. We'll think we see something. It's wonderful to stay safe on the savannah. It's a terrible way to invest, in my opinion. There are technical traders out there who will tell you the exact opposite. You're welcome to follow them if you choose. I don't. I won't. I don't believe that there's ever been evidence that technical analysis, so-called technical analysis, reading the charts, is indicative of long-term future success. I've never seen the data. Maybe it's out there. If it is, knock yourself out. Feel free to follow it. I don't. I won't. I'm a fundamental investor, which means basically I look at businesses. I look at their past, their present, their potential future, the things that make them successful, and I say, do I expect those things to happen in future? If the answer is yes, then I say, is today's price attractive? That's all I need to know. I don't care whether yesterday's price was double or half. It's entirely irrelevant to what I think the future looks like. I'm not going to, there's a logical fallacy called the call to authority, where I say, see, Warren Buffett does it and I do it too, or pick your favorite fundamental investor. However, in saying that, I'm going to still say that. Warren Buffett does it. It's good enough for Warren, it's good enough for me. That'll do me. Robin, I focused on super and reducing my mortgage. Do you have thoughts on this? I think it's great. I think focusing on super is wonderful. It's tax effective. It's locked up. That's the only downside to it. It's tax effective. It's going to be there when you want it. Reducing your mortgage, same thing, right? It's enforced saving. It means you paid more of the house off. You got more equity in your house. Those are great things. I wouldn't discourage anyone from doing either of those things at all. If you want to add shares to it, you want to do that and then buy some shares, go for it. You want to buy shares inside super, you want to self-direct your super, go for it. But I think that's a perfectly great financial strategy, Robin. Well done. Okay, let's get some questions on here. All right. Craig, I would like to understand more on unrealized capital gains and how that's impacted if you change fund managers. I was told it would impact me as I wanted to change to a lower fee fund or even self-managed super fund. All right. It depends is the answer. It depends on the fund you are in currently and how they deal with capital gains. Most retail funds manage your account as an individual. So there will be unrealized capital gains probably in your fund if you liquidate the fund. If you're in an industry fund, a not-for-profit industry fund, most of them pool the tax at a fund level, and the unit price you see allows for or includes those taxes. So the best answer, unfortunately, mate, I can't give you a perfect answer because it depends, is talk to your fund manager and ask. What I will say is don't be too worried. This sounds weird. Don't be too worried about triggering a capital gains tax event if you're changing to a lower fee or a better fund. Here's why. If I got $100 worth of profit I've made now, I'm going to have to pay tax on that either now when I change funds or in 10 years' time when I sell the asset, or 20 years or 30 years. And if I pay my tax now, I start from a new cost base. So I'm not going to pay that tax twice. It is true that deferring taxes tends to be better for you. So I'm not saying don't think about the impact. I don't know that I would let that drive my decision unless the unrealized gain is huge, unless you're really close to retirement or you were never going to sell the asset. But if you're in a fund, someone else's fund, they're going to sell that asset regularly anyway, right, on your behalf, unless you've got a self-directed option, again, which might be a little bit different. So ask your fund manager, ask your super fund is the only answer I can give you. I'm sorry to do that to you, but it depends on what your fund's own structure is, how they apply those tax liabilities. All right. Oh, man. Thank you for sticking with me. Apologies for the sniffling. I'm trying to battle through. I've had Quadril and Claritine and all sorts of stuff. I still can't stop. Jeff, I'd like some context to your article. Not all ETFs are created equal. Can you provide some examples of which ETFs we should steer clear of? Wonderful question, Jeff. Oh, my goodness. Okay. Let me take a half step back. This is a very quick potted history. In the 60s or 70s, Jack Bogle at Vanguard started a fund. And he said, I'm going to buy, this fund is not going to pick stocks. This fund is going to track an index. I think it was probably the Dow Jones, I guess, back then. It might have been the S&P 500. Anyway, I'm going to track an index. And I'm going to try and hold shares in proportion to the index. So the index goes up 10%, my fund should go up 10%. If the index falls 5%, my fund will fall 5%. I believe just tracking the index and keeping fees low. Why? Because I'm not paying a whole lot of investment staff. All I'm paying is some bloke or lady to make trades to make sure my fund stays in line with the index. I believe that's a good thing to do. And I can do it at a really, really low fee. So he did that. And that was called the Vanguard. It was called an index fund. It wasn't listed on the Australian Stock Exchange or the New York Stock Exchange that would have been. You had to send the money to the fund manager, the Vanguard. They invested the money, got you the market return, less a little fee. That was the beginning of it. What then happened is those index funds were able to be traded on the stock market. So rather than sending a check to the fund manager, having them send a check back eventually, you could buy the units on the ASX or the New York Stock Exchange. And it made it super accessible because if you've got a brokerage account, you can buy the ETFs as well. So the index fund became an exchange traded fund, i.e. a fund traded on an exchange, an index ETF. And they're great. And so what happened was people like me said, you should buy ETFs. They're wonderful. I love index ETFs. They're fantastic. And so that was the language. That was the view. That was the kind of the rallying call, if you like, for people like me saying, buy index funds. They're great. Buy ETFs. They're great. Because the two were synonymous. That's, again, I've made the same mistake. They're synonymous. What happened after that, though, was someone else came along and said, I know, I'm going to list my fund on the exchange. It's not an index fund. It's a fund that deals in, I don't know, make something up, Rwandan gold. And my Rwandan gold fund is now an ETF. So all of a sudden, when I used to say buy ETFs, they're great, I'm talking about index ETFs, and there's a Rwandan gold ETF. There's a Bitcoin ETF. There is a double leveraged NASDAQ short selling ETF, whatever you come up with. If you could create a fund and get it listed on an exchange, it was an ETF. So all of a sudden, when in the old days, ETFs were low-cost index tracking funds that were great, now an ETF is anything that's a fund on an exchange. And so I wanted to write that article to really make that point very, 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 very clear. Most investors have learned through people like me and others, ETFs are great. I now have to say some ETFs are great, many aren't. Which ones aren't, to your question, Jeff? I'm not going to give you exact examples because they might get myself in trouble with some people. Not that I mind that, by the way, but I just don't feel like slandering anybody. Most investors should only, if you're going to buy an ETF, the vast bulk of it should only buy a super low fee index tracking ETF, ASX 300, ASX 200, S&P 500, NASDAQ, global MSCI index. They're super low fee. They track the index, give you the index return. That's it. Now, there are times when you can and should buy other ETFs, but they're the exception, the very, very small exception to the rule. So which one should you avoid as a starting point? Anything that's not a low fee, broad-based index tracking ETF. When should you buy these? Two reasons. One, if they have a product or access to a market or asset class you can't otherwise get. So if you're an ASX investor, for example, and you wanted exposure to cybersecurity stocks in the US, you don't want to have a New York Stock Exchange bank, a brokerage account. So you say, well, okay, this is one way I can do it. That would be an option, but only if it satisfies the second criteria, which is you must have done the research on everything significant in that fund. Why? Because just saying I want your cybersecurity. Let me use I don't know, gold miners. There might be 10 gold miners in there. You might say, I'm diversified. I've got all 10. If you haven't done the research to say, what's the gold price? What's the cost of production for each of those companies? Are those companies reasonably valued? What is the future probability of success for those companies? Which companies are going to be outside that ETF and may win? In other words, if I said to you, buy 10 stocks at random, you'd say, well, how do I know which ones to get? I said, well, they're in Scott's ETF. Now, you might say, I like Scott, he's a good guy, I trust him, and that's fine, I hope you would. But if it was Jack's ETF or Jill's ETF, and you didn't know anything other than Jill had put some gold stocks in there, even if you like gold as an idea, you want to know that you know how much it's worth, how good are the companies, what's their future look like, what's the gold price. Too many people are incentivized or what's the right word? I'm trying to be kind here. It's presented to them as don't think, just buy it. It's diversified. It's an ETF. That's good. Not all ETFs are equal. I hope I've done that justice, Jeff. Tax implications of buying US shares from Pampa. Great question. Again, I'm not a tax advisor. I can't give you or anyone else tax advice. However, I own US shares directly. Here's three things. Firstly, if your company pays dividends, the US government will withhold 15% of that dividend payment, but you can declare that withholding when you lodge your Australian tax return. There's a tax treaty between Australia and the US, and that will be a credit for your local tax. So there's no additional tax that's taken out. It's withheld effectively, but you can offset that against the tax you would otherwise pay here at home. Capital gains tax is still payable to the Australian government because you're an Australian taxpayer when you sell those shares if you make a gain. Thirdly, if the account value is over a certain amount, I don't know what the amount is at the moment, you are liable for inheritance taxes if you own US shares over a certain value when you die. I figure I'm okay with that. That's my kid's problem. If I end up with shares worth more than that threshold, it's pretty high from memory. I don't remember. If you own more than that, there will be a small, it's small. And again, if you hate taxes, you may hate that. But for me, it's worth the opportunity to invest. Don't let tax, in my view, stop you investing in the US. It's never stopped me. I would hate for it to stop anybody else either. Excuse me. All right. Oh, my goodness. Christine, Scott, thank you. You're very welcome. Subscribe to your Motley Fool Advisor, open trading account, and purchase shares as 5 fundamentals. Fantastic. Thanks, Christine. That's just a nice compliment. I appreciate that. We're doing our best. Thank you very much. Hester, what's the minimum amount to invest to make it worthwhile? $1, $1, $2, $5. Get started. I mentioned during the week some of the super low-cost trading platforms. Maybe it's not $1, maybe it's $50. But seriously, some of these super low-cost platforms, I mentioned 3 that I use personally. They are not paid endorsements. CommSec, Sharesies, and Perla. Perla, Sharesies, and CommSec. I don't care about the order. I use all 3 for different things. Check those out. Check out others as well. don't let cost put you off getting started, because even if it's expensive now, it's not that expensive. Even if it was, when you add another $10, another $100, another $1,000, the snowball you're creating is well and truly worth whatever you're paying for that. Vanessa, these are great questions, guys. Thank you. We're in our early 50s, have a reasonable super balance. Well done. Have salary sacrificed extra into super. That's perfect. Instead of super, should we salary sacrifice into an index fund? Maybe. Again, I can't tell you what you should do, Vanessa, but two thoughts. One, super is very tax effective. You can't beat the tax advantages of superannuation. So, I want to say you can't. There might be some structure that maybe a family trust. There's probably ways to play silly buggers, but versus you're investing in your own name or investing in super, super is far more tax effective than investing in your own name. That's super, super worthwhile. The but is that if you want to take that money out or use it before you reach the release dates, that based on your age and whatever the money's been put in, you can't take the money out until a certain point. So if you wanted to be able to have access to that money before that date or take out money in that context, you may not be able to. So there are some restrictions that come with it. You know that. So it depends. I personally have some money inside super, some money outside super for that purpose. One is more flexible than the other. One is more tax effective than the other. I like having both, a finger in both pies. I don't think you'll lose going either way. I probably would suggest the closer you are to retirement age, the more likely it is that super makes more sense, because the time between now and withdrawal, as it gets shorter, the value of that optionality, the flexibility goes down, because you've only got a couple of years to wait. So have a think about when you might retire. Have a think about your, what they call the preservation age, how long till you can get to the money. That might determine which way you go. I think either is fine. I think probably in your 50s, again, I can't tell you what you should do, but for anyone in their 50s, generally speaking, super is probably the better option. But again, think about how much flexibility and optionality you want. Kathleen, don't mention my name, please. It comes up automatically, Kathleen, I think, unless they're coming up as anonymous on the screen that other people are seeing. So yeah, you haven't asked another question there. I think you've probably posted it and realized your name comes up. So that's okay. If you have another question, Kathleen, and you want me to answer it, feel free to try and chuck it in some other way. Car leases. I hate car leases, Dean. You've leased secondhand cars for up to 5 to 6 years, and it was quite cost effective. There's tax advantage on leases. I'm not yet convinced that, well, it depends on how quickly you turn the car over, is the honest answer, mate. It depends on the balloon you got to pay at the end. The finance companies aren't doing you a favor. You might save a little bit in tax. There might be some circumstances where a secondhand car is slightly cheaper based on the tax benefit, depending on how long you own it, et cetera, et cetera. In my experience, most people turn over leased cars too quickly and effectively give up that advantage by, kind of rolling over and buying or releasing more expensive cars each time. I said before, we got a 2016 Prado and a 2018 Hilux. The Prado was ex-demo. We've had it now for 8 years. The Hilux, I think, was 18 months old when we got it, so we've had it for 4 or 5 years. I expect I'll have that for another 10 years. I suspect that I'll do much better off holding that for that period of time than having a car lease. Some people say, well, I don't want a 10-year-old car. I said, that's cool. Just know that you're paying more for that purpose, and that's a financial decision. I'm not saying you, Dean. Anyone who says this, it's a financial decision you've got to make for yourself as to how you value the money you could save, invest, grow, versus rolling it over in cars every 2, 3, 5, 6 years. So up to you, and if that works for you, mate, go for it. David, I recently opened my super pension account and I found some extra cash to invest in either Odyssey or Digital Explorers or ETFs. Or should I reopen a pension account and pop it in there? David, that's probably a question I'm going to direct to your accountant in terms of what you should do. The pension accumulation phases of super are quite detailed and specific. I'd rather not, in a short time, I've got 20 minutes, try to get my head around your circumstance enough to have a really clear opinion. Yeah, I don't know, mate. Because the gains from pension accounts are tax-free, that's hard to beat. So I would suggest talking to your super fund, ask them about the options. By the way, you said invest in either. You can normally reopen a pension account in super and then have a self-directed option. You may be able to, for example, invest in some recommendations of ours using your super as the vehicle. So maybe there's an option C, which may be the best of both worlds if you do like the recommendations that we've made. Craig, love your humanism, mate. You're the Oracle of Australia. Dear, oh dear, Craig. We're in some trouble if I'm the Oracle of Australia, but I'll do my best, mate. I'm the Oracle of my office. Does that count? It's about as broad as I feel like I want to go today. But thank you, mate. It's very, very kind. At what point would you consider ETFs versus individual shares? Oh, dear. I'm a stock picker, so I go with the individual shares, but I reckon most people should go with ETFs. And if that sounds like a contradiction, then stick with me. If you invest in ETFs, you get the whole market. And that's a brilliant result. I've said many times this week, if you invested in an ASX 200 ETF or All Ords ETF, I think based on the Vanguard numbers, you went from 10 grand to 130 grand, 13 times your money in 30 years. That is spectacularly good. That's an ETF investment. Why wouldn't you do that? You only wouldn't do that if you thought you could do better. So the question really is for any individual is, do you think you can do better with or without help from somebody else? Most people should start with ETFs at the very least. Build a portfolio of ETFs. You get diversification. You keep your costs low. You don't make any unforced errors, as they say in tennis. You get a great diversified portfolio of stocks. You're away. That's pretty attractive. I would then probably invest in individual companies on top of that if you had the interest, or if you thought that you could, find someone. We'll try and help you if we can, but it needn't be us, to help you beat the market. If you can't beat the market, buy an ETF. I've said to our members, by the way, no one else says this because no one else wants to lose their customers. Not that I'm arrogant, I just think that's the truth. If you're in one of my services and I can't beat the market over the long term, go and buy an ETF and to cancel your membership. Don't pay me to give you underperformance. That would be dumb. And if I don't, I'll be the first to put my hand up. In fact, I'll probably get tap on the shoulder from the boss. But if we can't beat the market, we're not helping you. Go and buy an ETF. So start with ETFs, in my view, and then build on there, add some individual shares on top of that as your attempt to beat the market and earn better returns on top of that. Plenty of people who lose money should have bought an ETF. Warren Buffett, very glad he didn't buy an ETF because he's done remarkably well for 50 plus years. All right, 1 second. I'm going to mute myself. Man, can you tell this is live? Slightly embarrassing. Sorry, guys. I'm battling, but I'm doing my best. All right. Can you please explain cryptocurrency more and why it's a bad investment option? Jonathan, you are asking me to get flamed. There's a phalanx of Bitcoin lovers who are just waiting to jump on these comments and flame me when I respond to this. But hey, I'm either brave or stupid, so let's go with it. I don't hate Bitcoin. I don't hate cryptocurrencies. I am agnostic on them and I don't recommend them, which is kind of a negative, but it's a lack of a positive rather than an absolute negative. Warren Buffett talks about having a big too hard pile, right? If you don't know what's worth doing, don't do it. You don't have to hate it. You don't have to know that it's bad. You're just not sure that it's good. And if you're not sure it's good, then give it a miss. At least that's the idea. So for me, I was asked earlier about fundamental or technical analysis or investment. I'm a fundamental investor. What does that mean? That means I look at an asset. Can be a property, can be shares, can be whatever. And I say, what is the fundamental basis for assessing the value of this investment? Now, shares are easy. Woolies earns a certain amount of money in profits every year, or most years. It tends to go up over time. So it earns some money. Now, I know people shop there. I have a very, very strong conviction they're going to keep shopping there, at least for the medium to long term. I have a reasonable conviction about Woolworths' market share, its dominance in the market with Coles. Could it be disrupted eventually? Yeah, maybe by Amazon or someone else, but I kind of think I know roughly what it does and how it does it, and that it's likely to keep doing it. I think I know that Woolworths is a quality business. I think I know that they have a great culture and they're going to continue to do well. Now, grocery price gouging inquiry off, probably should use a different example, but work with me. I use Telstra because it just gets it out of that thing, right? So, I know that about Telstra. I know how much they earn. I can reasonably say, right, I reckon Telstra is a successful, large, well-known, I wouldn't say well-loved, but very high brand recognition business. It earns this much money. I think it's likely it'll probably grow pretty slowly from here, but probably keep growing because the population grows, more people are using mobile phones and the internet. We all want more speeds, so prices are probably going to go up on that over time. I think Telstra's going to earn a little bit more money next year and probably after that. And so on that basis, I can say, I can work out a value. I can work out how much I want to pay for those Telstra shares based on that assumption. Now, I can still be wrong about it, But I use those fundamentals to say, what does it produce as a business? What does it produce for shareholders in either profits that it retains and invests for more growth or pays as dividends? And I can assign a value to that. Now let's take gold because it's easier than Bitcoin. Gold is a precious metal that people like to wear, a ring on here, and or use in very small quantities in computer parts and stuff. How much is that worth? Well, it doesn't really produce anything. You can kind of use some of it, not much. So what's it really worth? Well, it's only worth what I'm going to pay for a ring, or you're going to pay for a ring, or whatever at some point in the future. So how do I know how much people are going to pay for an ounce of gold in a year or 5 years or 20 years? I don't know. Maybe they find a heap of it. Maybe they never find any more. Maybe mining gets cheaper. Maybe it gets harder. I don't know. There's no fundamental basis for assessing the value, and it doesn't produce anything. So I can't measure its cash flows or its dividends or its profits. So I simply say, I can't value gold. I don't know. And so for me, Bitcoin is exactly the same. It produces nothing. Now, it hit a high yesterday, I think, as we're talking about this on the 1st of March. Maybe it'll go higher. Maybe it'll go lower. Maybe in a year's time, it's half the price. Maybe it's double the price. There is literally no way to know. There are some speculations. There are some reasonably confident assertions in both directions. But can you know? No. So does that make it an investment or a speculation? Maybe it's even intelligent speculation, but it's still speculation. For me, that means it's not investment grade. It's not investable in the way I would define an investment. So I simply say, maybe it's great, maybe it's terrible. I'm not going to play that lotto. I'm going to keep investing in things I can reasonably assess for the business quality, future cash flows, profits, dividends, all that kind of stuff that comes with investing in real things. I don't mean because it's not real. I don't mean that as a slight. It's not a pejorative. I mean real as in shares are real, right? The it might be digital, but Woolworths is real. The investment property down the road is real. Those things are real. So that's how I assess what is investable. And the price to pay, that's the other thing, is you can't assess the price unless you have some basis for working out how much the asset should be worth based on its cash flows or its profits or something else. All right. 13 minutes. How are we going? Aston wants to know where Ram is. Andrew Ram Page is my podcast co-host. He and I do Motley Fool Money. If you're a podcast listener, check that out. Free plug for me, or for the podcast, for me and Ram. We do it together on Motley Fool Money. So just search for that on your podcast feed. There is some speculation. There might be something happening on the podcast front. So keep an eye on for that, Aston. Hassan says, thanks, mate. You're welcome. Pamela, invest for grandkids, don't know where to start. It's really hard, Pamela. I'm not going to tell you what you should do, but here's what you could do, or anyone could do. Go to one of those things I talked about, CommSec, Perla, Sharesies. Check them all out. Open an account in your name, and then put a little open bracket as trustee for ATF and your grandchild's name, close bracket. That's the name of the account. I would then look at investing in a range of shares and or ETFs and add money to that regularly as you want to, maybe a lump sum up front, maybe regularly in their name for a period of time. When they turn 18 or at some point after that, you can transfer the shares to them, usually taxation free because you held it as trustee for ATF for them. So go and have a look at that. CommSec, Perla, Sharesies, Pamela as trustee for the grandchild's name. Add some money regularly if you want to, or upfront and let it build from there. If you want some ideas, an Australian ETF and an international ETF, and that'll do you. You add shares to it if you want. As I said, we're a shares company. We can help you with that, but I'm not asking you to join up. Just saying we can if you want. Otherwise, a couple of ETFs. I own the Vanguard Australian Shares ETF. I like that one. I own a Vanguard Global Shares ETF. One of each of those you've probably done. Excuse me. Brandon, how to automate buying more shares? 2 ways to do it. The most automated way is some companies offer a dividend reinvestment plan, DRP. Not everyone does. Some do. If they do, simply tick that box. Opt in when you buy the shares, and then instead of getting a dividend in cash, they will send you a certificate saying you own more shares. That's the easiest way. It's completely automated. They do it for you. Be mindful you still owe tax on the dividend, so it's still you got to find the money for that. But if you can find that cash, the shares will build automatically for you. If not, it's not exactly automated, semi-automated, let's call it. Have a separate bank account, which is just for the money you invest. When you go buy shares, put the money in there. When they pay a dividend, put the money in there, and then just simply invest out of that account semi-regularly. It's not perfect. You can't do it automatically, but it's one way to make it work. Dallas. My 21-year-old received a 10 grand windfall game, not from her parents, says Dallas. What do you suggest she does with it? Dallas. I'm a finance guy. I'm going to put it aside for retirement, which is really, really boring. Actually, you know what I'll say? Spend $1,000. Take $1,000, spend it on something fun because there's some psychic value, some emotional, mental value in doing something kind of nice with the money. If it's a windfall, maybe it's from an inheritance or something else, or from a friendly relative or a friend. Spend a bit of it because that's fun and enjoyable, and it means the rest of it doesn't feel too painful. Getting 10 grand and not touching any of it can kind of suck, and you're kind of a bit resentful, right? Spend $1,000. The other $9,000, if you're saving for a house, it's a great start. Don't invest any money in shares you want in the next 5 years because we don't know where the share market's going to be in 5 years' time. So don't do that. Excuse me. Invest in shares for only 5+ years. 21, maybe you're not going to buy a house for 10 years. I reckon shares are a great place to put that money. No guarantees, no promises. I don't know what's going to happen in 10 years' time. If I had a 21-year-old who still got 10 grand, I'd say put it in shares. At least for the house, maybe for retirement. Yeah, I think that's probably what I'd suggest. Okay. Craig, just give me some feedback about the capital gains. Thank you, mate. How are we going? Time. 9 minutes. Dear. Okay, quick. I have a small holding that's been suspended. Are there any options to get rid of the stocks that are suspended? No. Unless you can find someone to buy them from you, which is possible, and lock in a capital loss. No, you're going to have to wait until the company liquidates or relists, and you can sell those shares. You've got to have a buyer if you're going to be a seller. So unless the company goes formally broke, you're stuck with the shares. Sorry. Jeff, how do you work out what a company is worth? That's a whole other kettle of fish, mate. I don't have time to do that. I couldn't do it in an hour, probably, maybe in an hour. Maybe we'll do that some other time. There's a million different ways. There is no perfect answer. You can only approximate it. Largely a multiple of its earnings, mate, is future earnings. So you work out what the future earnings are likely to look like, hopefully growing over time. You want to pay a reasonable price for that. That's the theory. How do you do it? Slightly differently. There's some maths involved. Another day for that one. Sorry, buddy, you can't do that this time. Aston, micro investing app Raise. I have no problem with Raise at all. Tends to be, the fees are probably not great. Here's the thing, a suboptimal solution that gets you investing regularly is better than an optimal solution that you don't use. So if you like Raise, then that's your answer. It's perfectly fine. I don't use it. The fees are too high for me. But again, mate, I keep doing it if you're doing it, because if it's working for you, that's literally the answer, right? Whatever gets you there, gets you there. Thanks, Aston. Zip small shareholding sale facility, Matt. Probably a little bit too specific for this podcast, over this YouTube. Colin saying, Vanessa, many super funds later choose ASX shares so you can salary sacrifice into super and buy index funds. There you go. Thanks, Colin. Kathleen, can't salary sacrifice. Need advice. I wish I'd give you direct advice, Kathleen. I'm not allowed to. You can go to an individual advisor, or you can join a service like ours, or grab Money Magazine or something. Depends what you need advice for in particular, mate. But I'm not allowed to give it. I'm a general financial advisor, personal financial advisor. If the dollar value is enough, and you're going to get enough of a return for the money you'd spend on the advice, then go for it. If not, you're going to have to kind of muddle your way through, which is a sucky answer, but it's the real answer. Jeff. 55% Motley Vanguard index funds, 30% ASX listed sector metals ETFs, mostly beta shares, 8% North Star stocks, or 12% cash. Thoughts? Can't tell you what you should do, Jeff, as you know. I wouldn't invest in metals ETFs personally for the reasons I kind of just talked about, but if you want to do that, go for it. People invest in gold as a hedge against inflation or as a hedge against volatility. If that's valuable to an investor, then that's great. I don't do it. I'd rather have the volatility and get more growth. I don't expect metals keep up with company profits, so I probably think you're going to get a sub average return from that. But if that makes sense to you, or you like it, you got an investment thesis, you like the volatility protection, you want the hedge, then knock yourself out. Chris, companies buy their shares back. Share buybacks are neither good nor bad. Depends on the price, like investing directly ourselves. If you buy back at a good price, it's great. If you buy back at too high a price, it's terrible. So it depends on the company. Warren Buffett's Berkshire Hathaway, I own shares. He's buying back its own shares. I reckon Uncle Warren's going to do a pretty good job of that. There are other companies that issue shares at low prices and buying back at high prices, just absolute madness. The capital allocation skills of the manager matters. I wouldn't have a view for or against buybacks, mate. I don't think it's something you can arbitrarily decide. It's about the company, the quality of the management, and the price at which they do those buybacks. Bottom line, you want to buy back the shares only when they're cheap relative to the earnings, not relative to previous prices or future prices, relative to the earnings. If they're expensive relative to the earnings, they're wasting your money. Lithium, dear Patrick. I don't love lithium because if you look at oil over the part of the 20th century, really quick answer, the oil price went up about 2 to 3% per year on average from memory. No, 2 to 3 times. I'm going to make this up now. I'm going to stop. I've written about it. Google lithium, oil, Scott Phillips, Motley Fool. I'm pretty sure you'll get a response. My Google machine's just tried to find it for me. Yeah, have a look at that. Oil, despite the boom in production and the boom in demand, hardly went up in price. Why? Because more supply came on stream. Most lithium investors say, lithium, EVs, cars, batteries, boom, I'm going to buy it, make a fortune. Maybe you will. If you'd said that with oil at the beginning of the 20th century, at the end of the 20th century, you would have done averagely, probably worse than average. I don't know what lithium will do supply-wise. What I know right now is the supply is outstripping demand, which is what I expected. I wrote that article 2 years ago-ish. I think that's probably, it'd be a brave person to bet against a meaningful supply response, which keeps prices low, in which case you can be right about the theme and not make any money. Quick anecdote, you've probably heard me say this one before. Airlines are a great example. 50 years ago, if you'd have told me about the boom in air travel, I would have sold everything, sold the kid, mortgaged the house, and bought airline shares, and I would have lost it all. Why? Because the airline industry, despite massive volume growth, made no money. And so over time, if you look at that, you'll be right on the theme, right on the volume even, but the financials don't necessarily give you a return. I could be 100% wrong. Lithium could be the boom metal of the 21st century, and maybe it's, you make thousands of dollars, thousands of percent buying and holding it. I wouldn't bet on it. And again, it's a too hard pile one for me, with oil as the example way back when. Aston, thanks, Scott. You're welcome, mate. Keith, two things: ASX 200 versus the X20 and the global shares ETF, hedged, not hedged. Wow, dude. I've got 3 minutes. All right. ASX 200 is the ASX 200, top 200 companies on the ASX. Pretty straightforward. There is a product out there which is the ASX 200 without the top 20. In other words, the 21st to the 200th biggest. Why would you want to do that? The answer is because in the Australian market, at least, banks and miners make up more than half of the index by weight. In other words, where the banks and miners go, so goes the stock market. If you believe that's great, you want to own them. If you think, well, miners are pretty volatile, tend not to make money over time. If you think banks are pretty expensive and how much bigger can they get, but I like the rest of the market, then excluding the top 20 from that group can make a lot of sense. It's why they listed the ETF. They know there's demand for it. I've gone full circle on this one. I used to own, or do own still actually, I think from a young bloke, the small ordinaries, which is the ASX 500 less the first 100, I think. Turns out there's as many miners in that as there are in the top 2 and the top 200. So you basically get the same proportional ownership. There's so many miners and financial companies right through the ASX. You kind of get the same amount no matter where you go. I haven't looked at it recently, mate. I'm not sure I want to spend the extra money in fees avoiding the top 20. I don't love them. I'm not doing it because I want to invest in them. I'm not so sure they're going to underperform that I want to avoid them. I'd probably get my exposure outside that from overseas. So I'd probably own like a S&P 500 ETF or a NASDAQ ETF or an all-world ETF. Excuse me. Thanks, David. Yeah, so I think I'd probably go with that. I don't hate the X20 though. I wouldn't tell anyone not to buy it. Okay. Panel asked about investing for grandchildren. The dividends. So, because it's your grandkids, you're gonna have to talk to your parents or your kids, their parents. I'm not a tax accountant. What I've been told is this: open a bank account in their name with their tax file number. Open a share account, brokerage account in your name with them as trustee with their tax file number. I'm told that, again, please get your own tax advice. I'm told that is enough to show the ATO you're investing for their benefit. In other words, you don't have to declare the income for you. It's declared for them in their name, in their tax file number. You're just the trustee of their brokerage account to make those trades. So bank account in their name, their tax file number. Brokerage in your name with you as the trustee for them, and the tax file number, use their tax file number for that account. I'm told that is appropriate and enough for the ATO. If you're not sure, get tax advice, please. Any difference between an ETF and an ETMF? Does the M just mean more fees? Yeah, kind of. It can also mean better performance, right? The other thing is, while I talk about being careful of managed funds, there are managed funds that beat the market. So, I'm not outright saying it can't be done, but if you're paying more fees, yeah, you've got a higher benchmark, a higher hurdle for an ETF. Jeff, VAS or VHY? VHY is the high yield Vanguard product. VAS is the Vanguard ASX 300. Go with the 300, mate, I reckon. Why? Because the high yield, high dividends, but they're businesses that I don't necessarily think are going to be great growth businesses over time. So if you want to adjust the yield, you might change your view. If you're saying to me, I'm going to invest for 20 years, which one's going to give me the best return? I would bet on the ASX 300 over the high yield ETF. Okay, up past 1 Sydney time. Pampo, thank you. David, thank you. Thank you, Pamela. I'm sorry about the sniffling, guys. It was either that or cancel it. And as I said, I had some Codral and some Claritine. I hoped I'd get through. I didn't quite make it. So my apologies for the sniffling and the blowing the nose. I just, had to do it to get through. All right. Thanks, Keith. Appreciate it, mate. Thanks, Brendan. Okay, folks, I hope that's been useful. Before we go, here's what I have to tell you. The marketing team are letting me offer you Motley Fool ETF Investor for $1 for the first year. Now, there are terms and conditions. I have to say that. You got to look at the order page, blah, blah, blah. $1 for the first year. Renews after that at the renewal rate, which at the moment might be like $29 or $39 a year. So it's really cheap, by the way. $1 for the first year. You can cancel the renewal at any time you want to. Contact our member services team if that's of interest to you. If you're already a Motley Fool member, by the way, you get that already. Don't sign up twice. You already get it. You get Motley Fool Investor as part of your membership. It's on the Motley Fool Member Center. If you're not, go to fool.com.au/ETF offer. That's all it is. ETF, the letters ETF, the word offer, fool.com.au/ETF offer. It's only available, I believe, until midnight Monday. And that's because we have to put an end date on it because this video will probably get archived. And if you're watching it in a couple of years' time, please don't try because it won't be available. But if you're watching this on March the 1st when we're live, fool.com.au/ETF offer, $1. You get our portfolio, ready-made portfolio of ETF recommendations. Talked about some already today, but the full lot's there. Monthly updates. You get access to the Motley Fool Member Center itself, which has got a truckload more stuff. I seriously swear, I'm not here to do the hard sell. For $1, you make your own decision. Someone asked me how much you need to invest. I reckon giving it a go for $1 is a pretty good deal. Look, yeah, as I said, it does renew after a year at the then current rate of $29 or $39, whatever it is. But $1, super cheap. Fool.com.au/ETF offer if you're keen. If you're not, that's completely cool. No pressure, no drama from me. I don't know, you'll spend $1 on, it's what, a third of a coffee, a fifth of a coffee these days. So fool.com.au/ETF offer. Thanks, Rural Jura. Thanks, Hester. You've been a member for 12 months. Awesome. Thank you, mate. Patrick, thank you. Very good presentation. That's very kind. I speak too fast, but we got through a lot. Colin, great work, Scott. YouTube, a good format. Thank you, mate. For more like this, there you go. We might do that. Remind me later. Jeff, thank you. Thanks for making it simple. Christine, thanks again, Scott. Thanks, Fools. I really appreciate you spending some time and battling through with me as I battle through. Have a fantastic weekend. I hope you've enjoyed Financial Literacy Week. Quick reminder, fool.com.au/education for all of the great content. It's all there for you. You'll get an email, I think, with some information about that. So if you do, check that out. Thanks for watching. Have a wonderful Friday afternoon, a great weekend, and I will see you soon. Fool on.